Good morning, everyone. This is Charalambos Pissouros, Senior Analyst at IronFX Global, bringing you the morning comment for the 9th of March. Bank of Canada and the Reserve Bank of New Zealand take center stage. At its latest policy meeting, the Bank of Canada kept its benchmark interest rate unchanged and noted that a lower Canadian dollar as well as fiscal stimulus would help to offset the drag of economic activity from plunging oil prices. Since the meeting, the Canadian dollar appreciated considerably, while data showed that GDP growth slowed in the fourth quarter and the unemployment rate rose in January. On the positive side, inflation is in line with the midpoint of the Bank of Canada target range, while oil prices recovered and managed to reach $38 per barrel on Monday. Since the anticipated fiscal measures have not been introduced yet and the painful impact of plummeting oil prices has begun to dissipate somewhat, we expect the bank to remain on hold at this meeting. We believe that officials will prefer to take the sidelines for now and monitor the effect of the upcoming fiscal boost. Markets appear to share this view and they are pricing in only a 10% probability of a rate cut. As a result, the reaction in the Canadian dollar is likely to be determined by the tone of the statement accompanying the decision. As for the Reserve Bank of New Zealand, the bank also held its fire at its latest policy meeting, but signaled that further easing may be required over the year to ensure that inflation moves towards its target range. Officials also pushed back the date by which they expect inflation to hit its target, quoting a softening global economy and falling dairy prices. After that meeting, data showed that inflation slowed considerably in the fourth quarter and is now one touch above 0%. Perhaps even more worrisome is that the two-year inflation expectations slipped to their lowest level in more than 2 decades, threatening to lower actual inflation even further. To make matters worse, since the meeting, the global turmoil intensified, dairy prices declined even further, and the kiwi appreciated. Taking all these factors into account, we believe that the bank is likely to cut its policy rate by 25 basis points at this meeting, mainly in order to preempt a slip into deflation and to prevent inflation expectations from falling further. Markets are currently pricing in a 42% probability of a rate cut, which suggests that if the bank acts like we expect, the New Zealand dollar could plunge on the decision. Overnight, the Shanghai Composite index closed down 1.15%, led primarily by losses in the energy and commodity-related sectors. The sell-off in commodities may have been fueled by an announcement from the Chinese province of Hebei, stating that the province will aim to close more than half of the steel factories by 2020. This sentiment could spill over and negatively affect European equity markets today as well, particularly energy and resource-related companies. As for today's indicators, from the UK we get industrial production for January. Expectations are for a rise, a turnaround from December. The forecast is also supported by an increase in the manufacturing PMI for the same month as well. A rebound in industrial production could add some fuel to the pound's recent recovery. From the US we get wholesale inventories for January. The only speaker we have scheduled is the RBNZ Governor Wheeler, who will hold a press conference following the rate decision. For more information, including technical analysis, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX Global, wishing you solid trading.